Hey everyone, welcome back to the channel. If you're an investor looking at private real estate deals, venture opportunities, or other alternative investments, you've probably thought about asking your financial advisor for their opinion. But here's a hard truth. Most financial advisors are not qualified to analyze these types of deals. It's not their skill set, and understanding why is crucial for your investment journey. Let's talk about it. First, let's be clear. Most financial advisors are excellent at what they are trained to do. They excel at helping you build diversified portfolios of traditional assets, stocks, bonds, mutual funds, ETFs, retirement planning, college savings. Their training focuses on public markets, asset allocation theory, and managing liquid investments. They work within regulated frameworks, primarily dealing with products vetted and approved by large financial institutions. But here's where the disconnect happens. Analyzing private deals is a different ballgame. When you bring them a real estate syndication, a venture capital opportunity, or a private equity deal, you're asking them to analyze something entirely different. For real estate, it requires deep dives into pro formas, understanding local market dynamics, zoning, construction costs, property management, debt terms, and complex legal structures. For venture private equity, it involves assessing private company financials, intellectual property, management teams, market sizing, and industry-specific risks that don't trade on public exchanges. These are highly specialized skills that are simply not part of the standard financial advisor curriculum or their day-to-day responsibilities. They don't have the tools, the databases, or the legal authorization to properly vet these unique, illiquid, and often opaque opportunities. This leads to the shelf problem and the pivot. Financial advisors work for firms, and those firms have a specific shelf of approved products they can recommend and get compensated for. Your private real estate deal isn't on that shelf. They can't advise on it, and they certainly can't get paid for it. So, when you ask them about investing in your friend's multifamily deal, they're likely to pivot. They might say, "That sounds interesting, but we've got this Apollo Capital Management Fund 9 you can buy into instead." This isn't necessarily malicious, but it's a reflection of their firm's structure and their own compensation model. They're steering you towards what they can offer, which often includes large, diversified private funds that come with their own layers of management fees and performance fees, which of course help compensate the advisor and their firm. So, when it comes to alternative investments, are they always looking out for your best interest? While most advisors genuinely want to help you achieve your financial goals, their advice regarding alternatives can be influenced by what they are authorized to sell and how they are compensated. The fees associated with these large funds can be substantial, often taking a significant cut of your returns before you even see them. They may not truly evaluate if a direct real estate deal, with its potentially different risk-reward profile and fee structure, is a better fit for your specific situation than their proprietary fund. The takeaway: understand your financial advisor's expertise and their limitations. They are invaluable for traditional portfolio planning, but for highly specialized alternative investments like private real estate, seek out specialists. Experienced operators, mentors, and investors who are actively doing those deals. Educate yourself, build your own network, and always do your own rigorous due diligence. Knowing who to ask for what kind of advice is key to building a truly diversified and profitable investment portfolio. If you found this helpful, give it a thumbs up, subscribe for more insights, and let me know your thoughts in the comments. See you next time.